Hello and welcome to ET Insight, where we get you a 360-degree view of the big picture in business and economy. I'm Sridhar Ramakrishnan, and here's what we have for you on the show today. Why the Davids of India's pharmaceutical sector are up in arms against the world's Goliaths. And can India strike a fine balance between the industry's interests and those of the consumers? Our top story first. India is the world's third largest producer of pharmaceuticals, and growth in this industry has so far been led by a robust domestic sector. But not anymore. Now it's deep-pocketed multinational companies that are ruling the roost. The loss in market share has made domestic companies draw their swords, and Big Pharma is not taking the matter lying down. So is there a solution in sight? Nikhil Sivadas finds out.
It's definitely not a battle of equals, but the underdog is being heard loud and clear. And while no one has raised the alarm bells just yet, this match has all the makings of being a hellraiser. After all, there are big bucks involved, and at the heart of the matter is a turf war for India's $21.6 billion pharmaceutical industry, which is largely dominated by branded generics. The big question that everyone's asking is whether foreign investments should continue unbridled in the sector.
If India wants to go up the value chain in pharmaceuticals, it needs to do a much better job on research and development, and the place where it can be stimulated, learn, be challenged is from the international companies. And that's good for India, and I think bluntly the industry here needs to make a much better case of the benefits which flow, not simply the scare stories, which I think have very limited evidence to support them anyway.
The limited evidence in this case is the rising market share of Big Pharma. According to BCG, MNCs account for about 32% of India's market share currently, from about 26% earlier. It seems like a relatively small share at first glance, but the pace of growth is what has taken everyone by surprise. All thanks to mergers and acquisitions. Big ticket takeovers by MNCs in the past few years include Mylan's takeover of Matrix, Japan's Daiichi Sankyo's acquisition of Ranbaxy, Sanofi Aventis' acquisition of Shanta Biotech, Hospira's acquisition of Orchid Chemicals, and the largest and most recent deal of Abbott Laboratories taking over Piramal Healthcare. This spate of deals has raised fears of cartelization by MNC companies.
From Daiichi acquisition of Ranbaxy to Piramal acquisition by Abbott, the prices have gone up, not gone up. Can it go up? In a current scenario, it's very unlikely. Why it's unlikely? Because before acquisition, the entire transaction will have to go through a process, that is, through the critical scrutiny of Competition Commission. Competition Commission will analyze what will be its impact on competition. An impact on competition is having a direct relationship of price increase.
While there are checks and balances in the system, the big question is whether India needs to take a second look at the rules and regulations that bind the pharma industry. Enter the Planning Commission, which has suggested that all M&As come under the scrutiny of the Competition Commission of India, or CCI. Currently, only M&As of target companies with a turnover of about 750 crores and assets worth more than 250 crores are vetted by the CCI.
But one thing everyone is clear, there must be a check on large acquisitions that can take place or will take place, which could distort the structure of the industry. And may I say that what we are proposing in terms of using the Competition Commission is what all modern free market economies do. The European Commission has a very strong competition management system, and so has the United States. So in that, we are joining the world, as it were, and ensuring that we get the benefits of investments from other countries, while ensuring that they do not distort our own healthcare industry, pharmaceutical industry here in ways that would affect the prices of drugs and medicines for our Indian citizens.
Prices of drugs and medicines is a sensitive issue. According to industry insiders, prices of drugs have risen between 5 and 15% in the past year, and a majority of the price rise has come from MNC players. That's perhaps why the Health Ministry recently had raised an alarm on the possibility of drug prices rising because of Big Pharma's expanding territory, and suggested safeguarding FDI in the sector. But the Planning Commission disagrees with that view, and for good reason.
FDI in pharma industry became 100% in 2002. Any reversal will not only have a chilling effect on investments in pharma industry, but will give very negative signals to the global community on any other investments, whether it's in retail or healthcare or insurance. So it'll be a very misplaced policy decision if it happens.
So are the fears of the domestic companies misplaced? Let's address the issue of prices and unfair competition. Companies cannot raise prices by more than 10%. Any increase above that needs to be justified to the National Pharmaceutical Pricing Authority or NPPA. And mergers and acquisitions need to have pre-acquisition approval by the CCI and a post-acquisition approval by the NPPA.
Drug prices in India are quite competitive, very low. What is going to happen 10 years from now, I cannot predict, nor can anybody else. I think, drug prices for novel medicines are bound to go up. That is because they are patented and you're giving them monopoly rights, exclusive marketing rights to recoup their investment in research. So to that extent, patented drugs, the competition will be limited and prices will be high. But that's inevitable. But the prices for generic products and products which there is no restriction for entry from multiple players will always continue to be low, and I don't think that is going to change or that should be a cause for concern.
Today the market is 99% branded generic. There are only 14 patented products available. Even for those there are therapeutic equivalent available. For every molecule there are not less than 50 brands, and the prices are so low that you just cannot dominate the market. So I think this is not based on any factual data. The maximum market share of the leading company is only around about 7%. How at the maximum share of any product in any category, it doesn't go more than 20%. How do you expect this dominance to take place? Even you assuming the multinational company acquired the top 10 companies, still the dominance will not take place.
But domestic companies are not buying that argument. According to the Indian Pharmaceutical Alliance, a body which represents Indian pharmaceutical companies, foreign originator companies are scouting for new markets for generic drugs as the pipeline for new products are drying up. The generic segment is growing at 50% and a large pool of products are going off patent. The IPA, which has been lobbying for domestic players, is of the view that foreign companies have found an easy route to enter the market via acquisitions, and are not investing as much as domestic companies in R&D and in fixed assets in India.
There is nothing wrong if companies want to come in and set up a 100% unit for doing a research or manufacturing, that's fine. But if their intention is to acquire businesses, which in other words means only doing trading activity. They are not even manufacturing here. They would buy goods manufactured by another company and they would do only selling and marketing. Now question which is raised is, would country benefit by such trading activity? Do we need this trading activity by multinationals in the field of pharmaceuticals? Or do we want them to bring the new technology in the country?
The IPA has raised the alarm bells on the unrealistic valuations offered by foreign companies. In a presentation submitted to a high-level committee in the third week of August, the IPA cited the example of a 17,000 crore rupee acquisition for a company which had a turnover of just 1,900 crore rupees and profits of just 200 crore rupees. The IPA is of the view that these valuations are creating barriers for the consolidation of the industry and will push promoters to sell off. And those that don't will be wary of stiff competition from deep-pocketed MNCs and slow down investments by local companies. It has therefore suggested permitting FDI by the automatic route if foreign players bring in new technology and set up greenfield projects for the local production of patented drugs and for discovery research in India. But the Planning Commission is against that. Here's why.
There are very few MNCs who have the appetite to buy Indian companies. And there are even fewer Indian companies who would want to be sold or who are actual qualifying candidates for being bought over. So I think it's a fear that is taking place right now, and there is a little panic situation. But if one sits properly and discusses and debates, I don't think it is going to be that big a problem as people envisage it to be. But as I said, there will be very few companies who are going to be bought. After all, India has more than 12,000 registered companies today, regular suppliers who are national and international players. And very few would be on the block.
There may be a few companies on the block right now, but that's not to say it will not change in the near future. Picture this. In 2009, the top 200 companies accounted for 70% of the market share. Today, the top 50 companies account for 80% of the market share. Is there a magic potion to ensure that the already fragmented sector will not be skewed further?
All companies in India have enjoyed enough concessions from the government by getting grant, by getting almost concessional interest at 2% from the government for our projects, and all these facilities would go away to the foreign companies. So what I am suggesting whenever I am talking to the government people, at least bring something that anything which you give it or hand over this company, whatever loan you have taken from us, grant you have taken from us, return it with 18% interest, and at least give us the 20% of your price which you have sold it away. Bring such restriction so that it will not go very easily, and if it goes, at least government would be benefited, and that benefit can be passed on to another Indian companies nicely.
While protecting the domestic industry's interest is important, so is getting investments in the sector. And whichever way this battle goes, indications are that the rules of the game will be tweaked, if not changed.
So how much better off or worse off is the man who really matters, the consumer? That's coming up after this short break. Stay with us.